Hey, welcome back, Ranking members, and also a special welcome to the general public for our once a month open general market update. It is October 31st, 2025, Halloween. Where are we with the markets here on October 31st? Let's take a look. All right, before we begin, let's remember that all of the Ranking LLC presentations are for educational purposes. And before we dive in, I know some of you are not familiar with Ranking Insights, so I just wanted to remember that here is our website, rankinginsights.com, and just a couple new things. We've actually just released a Mastering Exit series, which is all about selling stocks, offensive sell rules, defensive sell rules, as well as situational selling. Really a great series if you're a member. So those of you that are early in your trading career, we have a basic membership. You can see these are all the types of quality videos you will get, and also a live monthly coaching webinar to take all of your questions. If you are a more seasoned trader with more years of experience, you're going to enjoy the weekly focus list. I'll share specific trade ideas with pivots, stop losses, and we manage trades along the way, and incredible amount of advanced material and content in our monthly videos. And we also do a live huddle for your questions. So that's enough with the 1-minute plug, but please check us out. Check out the website. There's also a lot of free content on the website. Just go under the free content tab. Okay, let's get into the market update. We're going to look at the indices, the market cycle, and some signposts. Then we're going to talk about patience and balance, leadership, and then we'll put all the pieces together. All right, let's start off with the indices. This is the NASDAQ composite. This is as of 11:30 Eastern time. I'm recording this video around 12:30 Eastern because I have a commitment later in the day around 4 o'clock. So it's not my normal time. But this is what they look like. We're slightly down on the day. We talked about it with members. We've had 4 very strong gaps up in a row. We also had a lot of news, a lot of really, really good news. So it's all been kind of priced in now. We had NVIDIA hitting 5 trillion. The Mag 7 had their earnings, all generally positive, other than a negative reaction to Meta. It's also interesting that since probably October 10th, the speculative names have really cooled off. We did get a Fed cut, but there was a hawkish tone that maybe we won't get one in December. And then we had the tariff deal with China, which really was a sell the news event. So a tremendous amount of good news. Market had really run up strong. So it's not surprising to say we're going to come back a little bit. Some of our indicators have been flashing that we're due for a pullback. So I want to turn to the S&P 500. I've been mentioning, and I put out a tweet, the breadth of the market is getting narrower and narrower, and it's really giving us a caution alert. There's 2 tools that we use that look at some of these extreme breadth divergences. One is what we call the bloodbath indicator. This is a Larry Williams tool. And generally, when you get the New York Stock Exchange with at least 128 new lows, that's really a sell signal, and that something could get worse. Now, in addition to that, we also triggered the Hindenburg omen, which is a measure, again, which is primarily split breadth in the market. And usually what that does is it opens a 30-day window that potentially you could have a sharp pullback. And you'll also notice that we've had a negative divergence for 4 months where the index, the S&P, is making new highs, new highs, new highs, new highs, yet the percentage of stocks above their 50-day, represented by the pink line, is decreasing and decreasing. The market has become very narrow. Now, just because we had these doesn't mean they're going to be an avalanche or anything. With these signaled back here in July, you can see the Hindenburg omen and the bloodbath indicator, and really the market shrugged it off. So this is a caution sign. It's not a time to panic. Now, if you don't know what I'm talking about with these indicators, I do have a short 15-minute video called Extreme Market Breadth Indicators, and you can get that by going to my YouTube page, which is right here at Ranking LLC. Tremendous amount of free content, and you can look this up and watch that 15-minute, which talks about what are these indicators. All right, as I mentioned, the bloodbath indicator, this is just a chart looking at new lows. And you can see here the last 2 days, we're on that 130 level. As I mentioned, August 1st, and October 10th, we got very close to that number, and the market really shrugged it off. We moved higher. So it's not a death knell, but I will say this is the highest number of new lows going all the way back to the April mini bear. So it's something to be concerned about. And other times that we had this signal of the bloodbath indicator, you can see it. It started to signal and fire back in December. It fired in January, and then it kept firing for 4, 5, 6 days in March. And that was really telling us the breadth of the market was not acting right, expanding new lows. And eventually we had the meltdown in April. So it's something that we want to pay attention to and be a little bit cautious here with the market. Okay, let's look at the S&P 500. Now, the Hindenburg, I have some data going back to Hindenburg signals. And if you look out 1 month from a signal, about 70% of the time, the market will have pulled back 4 to 6%. So if we use that as simply a guide from current levels, a 4% pullback would actually bring us right down to the 50-day. Here's the 4% pullback line. And you'll notice that for those of you that are members, we talked about October 10th being a very important candle, and we were using the midpoint to really gauge accumulation distribution. And this 4% pullback would bring us right down to the midpoint of that bad break. So that's certainly a possibility. The second possibility is we undercut. We break the 50-day, and we maybe come down to 6% pullback. And that would be around 65.09. So just a couple of guideposts that just because we have a pullback doesn't mean the market can't move higher, but we want to have our expectations in line when we're starting to see the bloodbath indicator and the Hindenburg omen. You'll also notice that the relative strength line of the S&P has been not performing well against the NASDAQ. The NASDAQ has really, really led the market since the April lows. This is the relative strength. All right, let's move on to the market cycle and some signposts. All right, here's a Ned Davis research chart. This is showing the composite NASDAQ cycle in blue. This is how the seasonality tends to play out. And generally between August and October, that's usually when the market pulls back. You'll notice that this is really an outlier year. This dotted line is actually 2025. And you can see that 2025, we're not following the script. We have been continuing to push higher. We had a pause on October 10th for about 2 weeks. Things got a little bit dicey. The Qs and the Mag 7 have really rescued things this week. But again, I mentioned before, the breadth of the market suggests maybe we're going to pull back now. Okay, this is from Bank of America. This is actually looking at the US presidential cycle, particularly in year 1, and they're looking at it by month. So since 1927 is their data, you can see here that in general, November and December are positive months, year 1 of a presidential cycle. So, there's a lot of talk about seasonality, and it's true. We're entering the strongest seasonal period for the market, which tends to be November, December into January. But I would emphasize that seasonality, it may improve our odds, give us a little bit more edge in our trading, but it's not a blind signal to be really, really aggressive. There are times when November and December can be times when the market peaks, and sometimes we do not have a good December. So don't get blinded by seasonality. All right, this is a chart of the Dow. This is, again, Ned Davis research, and this is looking at when the Fed cuts rates for the first time, and it looked at 2 scenarios: a Fed rate cut that never had a recession in the next 12 months, and they looked at it and say, what about the first cut when we did have a recession? What was the performance of the Dow? So you can see here that the red being the first cut and there was no recession in the next 12 months, you can see the very, very powerful move in the market. Even the blue is also positive, but you can see it's much more, a little, less of a gain. If you're about 110% gain and you got about a 24% gain when no recession. So there's talk about weakness in the economy. So who knows, maybe we will have a recession next year, but maybe we won't. Retail sentiment. This is the sentiment of the American Institutional Investors Association of Individual Investors, excuse me. And we looked at this closely on October 8th. We had talked about how incredibly bearish that individual investors were in mid-September, and the market took off. Then 3 weeks later on October 8th, you can see that everybody swung the other way. Retail investors in the crowd was finally becoming more bullish, and 46% were bullish. And we said, boy, is this going to be just the opposite and fool the crowd? Because this might be before a correction hits in. And of course, as you know, October 10th was a pretty bad day. So you'll notice now that we now have on October 29th, a 44% bullish reading. It's only come down a really tiny amount since this. So again, you have to wonder if the crowd is going to be wrong. They're getting more bullish versus last week. Tried a big change, and maybe that's when the market absolutely corrects and fools the majority. All right, market cycle. Let's talk about Signposts. In our video on October 17th, 2025, I went through all the long-term signposts that I use when evaluating a bull market. Those of you that are not members, I encourage you to join a membership. You can go back into the archives, watch this video, and get all the signposts. But we're just going to update one of them in this video. And that is really the divergences that we're seeing with the S&P 500 and the percentage of stocks above their 50-day moving average. Again, similar to the NASDAQ, the index I've marked here with these vertical lines makes a new high, and we had a new high with percentage above the 50-day. You can see new high here, new high here, new high here, but look how the percentage of stocks that are actually participating is shrinking and shrinking. And you can see the dramatic turn down this week because it's been dominated by really the Qs and the Mag 7. So this is a divergence that's been going on for 4 months. It can go on for a while. You know, when you look back at major market tops, sometimes there's 4, 5, 6 months of lag before a market will top. But this has been going on for 4 months, so it's definitely a caution sign. Now, I also wanted to talk about markets topping, the process in general. And I'm using here the 2007 market topping process by market capitalization. This is really a chart. What I'm trying to show you here is that when a market tops out, it's a process. It doesn't happen in one day. It's a gradual process. And over, you will see that the most speculative names will top out first. In this case, microcaps topped out here 4 months before the actual top in November of 2007. You'll see that small caps, the next group of kind of speculative stocks, they topped out 3 months before the ultimate top. Mid caps were similar. And you'll notice that the most quality stocks, the large cap stocks here, in the Qs, they were the very last stocks that an institution was willing to sell. And it really occurred right around the top. So this idea of speculative stocks top out first and the quality is last is an important it's an important process to have burned into your brain. I'll show it again here. Now I'm going to use the 2021 market topping process. And again, you can see here, the green line is the IPO index, IPO ETF. It topped out in February of 2021. The ultimate top in the market didn't happen until way around November. One of the hottest groups in the market was enterprise software. And you can see it topped out in February. Small caps were next to top out. And gradually, it wasn't until the very end that we saw the large caps really topping out and making new lows. So it's a process. You'll start to see sectors and tops from the more speculative top out first. So what does it look like today? Are we topping out here in 2025? So I've just lined up a number of the similar indexes as I just had on the previous 2 charts. You can pause the video here and take a good look. The semiconductors are still making new highs. That's very positive for the market. You can also see that the Russell 1000 growth, new highs, NASDAQ at new highs, Qs at new highs. And if you look really closely, you'll see this green line here. This is the IPO. This is speculative, young IPO companies. This is the sector that we would expect that probably would top out first. Now, right now, it's correcting. We don't know if this is a top. It just might be a correction. So we don't want to read too much into it. but this would be the first one we'd see if we're forming a larger top in the market. Right now, I would have to say all the other lines we're looking at, the rest of the picture looks fine. So we'll keep our eye on this, but certainly IPOs are topping. Now, if we go deeper into these kind of risk-on sectors, these ETFs, here's that IPO ETF, and you'll notice that it's actually corrected about 11%. So it's definitely come back. And then when you look at the relative strength line of IPOs versus the NASDAQ since September, you can see how IPOs have really underperformed now for a good almost 7 weeks. So definitely speculation is coming out of the market. If we look at the ARK Innovation Fund, ARKK, it's had a really good run this year. And you can see it has also pulled back almost 10%. It looks a little better than the IPO chart, but again, this is speculative, young companies, growth companies. So they're pulling back. Right now, we'll look at those and say, this is a pullback. We don't know if it's part of any larger top. As I mentioned, the markets top out in a very gradual process, and you'll see the growth stocks, the leading growth stocks will gradually top out one by one as the market is still moving higher. This is the 2020, 2021, and this is where some of the major leaders of the market topped out. You can see PayPal and Roku topped out here, DocuSign, here's Snap. You can see SE and Asana and Affirm didn't top out over here, and some of the final ones to top out were Shop and Cloudflare, Net. So it's a gradual process. That's why we want to watch the leading stocks very carefully, because if we see them topping out, we want to make note of that maybe the market is moving to more distribution. Those of you that are old enough and trading long enough, you'll recognize the March of 2000. This is the dot-com bust, the huge bull market. But the point I'm trying to make is leaders top out gradually. Here's the big run up into the March 2000 top. Qualcomm topped, basically 3 months before the ultimate top. Yahoo, 3 months before the ultimate top. You can see VeriSign was still about 6 weeks before the top. And you can see gradually the stocks top, and some of them actually topped on the other side of the peak of the NASDAQ, such as Oracle, Cisco, Emulex, and others. This is Broadcom when its symbol actually was BRCM. So gradual process, watch the leaders to see if they're topping. All right, let's now move on to the importance of patience and balance. Last week, we talked about mindset. So if you're in the right stocks right now, if you're in the Qs, triple Qs, you're in the Mag 7, or if you're in select AI stocks, you're probably have done really well. They're holding up well. There's some great relative strength. But if you're not in the right stocks, you may be really struggling because not everything is moving. As we mentioned, the participation of leaders to the upside is actually getting narrower and narrower. So stock selection becomes extremely important. For those of you fortunate to have some really big winners, you got to be really grounded here, because you want to make sure you stay patient about your entries and manage your risk. There's a number of danger signs. If you're making quick money in the market, your account is growing fast, you can get really excited, and you got to watch out for the danger signs. So let's go over what are the danger signs we should be indicating that our emotions are getting too high, or we're getting a little bit impatient with what's happening in the market. The first one is FOMO, the fear of missing out. If you find yourself starting to chase extended stocks with no discipline, no buy setup, but you just feel like you have to get in, that's a bad sign and a bad strategy. If you find yourself checking your equity balance in your account 10 times a day or more, that is a bad sign. I've always advocated, don't look at your account equity when the market is open. You don't want to see red and green flashing on your screen. That enhances your emotions, and we try to keep our emotions balanced. If you find yourself just feeling really excited, you're making good money, you have good gains, and you all of a sudden start to get a spreadsheet and say, I'm going to calculate my forward returns. If I can only do this, I could retire in the next 2 years. If you find yourself calculating forward returns, that is a major danger sign. So think about it carefully. If you are using excessive leverage, If you say, well, I want to have 3x ETFs, I want to use 0-day to expiration options, I want to load up on margin because my picks are working. This is another sign you're getting a little bit out of control if you're not using proper setups. If you find yourself taking oversized positions, you've had a couple of good winners, and then you say, well, I'm going to double the size because you want to make money faster, that is overconfidence. And that's exactly when the market could slap you in the face with a bad loss. So watch it if you find yourself taking oversized positions. And you'll see a lot of people cheerleading each other on X about how much they gained, how much money they made this week or last week, or how their account is doubled. And they start talking about how smart they are. And everybody in the comments says, oh, you're great. And they're cheerleading. This is a bad sign, and you shouldn't do it or participate in it. If you do, you are reaching a really emotional state. And if you start sharing your opinion on everything related to markets, that's also a bad sign. When we are in a bull market, it makes everybody look smart because stocks are rising. You are no smarter when in a bull market than you are in a bear market. So your opinion means nothing in a market. So I just want to take the time to ground everybody. My opinion means nothing. Your opinion means nothing. We have to take our cues from the market. So patience and balance. Now, in our Raindrop series, our basic membership, we have a great video called A Trader's Achilles Heel. We talk about some of the things that really can trip up a traders. And one of them, as I just mentioned, is your emotions. You know, I won't go over all of this, but if you become a member, you can get access to this video, and we break down why winner's tilt is a really dangerous thing, and the house money effect. You know, when you have a lot of black chips at the casino, everybody starts to gamble really, really aggressively. So again, if your account has a lot of gains, you might be getting out of control, taking bigger risks than you normally need to. So just take very much an awareness of where you are. We also have a video at the advanced level called Psychology and Mindset 2, and we talk about this in detail, emotional balance. Mark Douglas says, accepting risk means accepting the consequences of your trade without emotional discomfort or fear. It's being a little bit more robotic. We always have to keep our ego in check. And that means when times are good and we're profitable, we don't want to get too overconfident. We don't want to oversize positions, and we want to stay grounded. As I mentioned, you actually play more defense when you're doing well in the market. And when times are bad, and believe me, times will be bad in the future, we go through losing streaks. We might lose on 5 or 10 trades in a row. Our portfolio may take a bad hit on one day. Maybe we make a bad trading mistake or a bad error, and our confidence sinks. We don't want to get too emotionally low just because we've gone through a losing streak. We want to stay balanced. In A Trader's Mindset, we talk about this very, very fine line. It's overconfidence, which really is characterized by oversized positions, ignoring your risk, and being emotionally high because you're on a winning streak. And then there's this line to say, now I actually lack confidence. I'm scared. I've taken losses. I'm holding losers. And I'm not in sync with the market. This is a very, very fine line. And you want to make sure you're always protecting your physical capital, your dollars, but you also need to watch your emotional capital and try to manage your emotions. All right, let's go into leadership right now in the markets. Okay, this is the slide that I showed 1 week ago at the general market update. And we had identified, I had identified what I thought were the leading stocks that are showing the greatest relative strength. And they were all colored. Now, what I've done here is exactly the same slide, but I've left the names in blue are the ones that I think are showing really good follow-through action, acting really, really strong. And I've grayed out the ones that are just not as strong as the blue. So some of these are really the cream rising to the top. You can see we're looking at new highs, pullbacks, 50-day pullbacks, and certainly some of the groups that we thought were really, really strong. So let's take a look at some of the charts. Data storage has been a very hot sector. This week, we had Seagate report on Tuesday. It had a big gap up on Wednesday, but it's down today on lower volume. So this is a big reversal here, but you'll notice that the volume, at least so far, and I cut this chart, around 11:30, 12 o'clock Eastern, maybe these stocks are showing some exhaustion. Western Digital had their earnings last night, gapped up on the open today, way up here, and it's actually pulled down. We'll have to see how it closes, but at the moment, it looks like it's reversing. Maybe there is some exhaustion in the group. SanDisk, which is a stock that members and I personally bought way down here at 49. We've been riding this one the whole way up. It also had a nice move today, was trying to move new highs, and it's come back. So we're getting a reversal in SanDisk. So let's see where these stocks close the day today. But earnings for SanDisk are still a good month away. So we've got December 3rd to watch out for SanDisk. But it's possible that the entire group, including even Micron, might be getting a little exhausted and they need to have some consolidation. Now, those of you who are members, what I've been doing over the last week is a little work, precedent work. I'm looking at SanDisk because most of the members are in this stock way down here. And I'm comparing it to CoreWeave as a precedent. And we're going to go over this in great detail, I think, on Sunday. But I'm just trying to look at some of the pullbacks that we're seeing in the move in SanDisk and seeing what we got in CoreWeave. CoreWeave had an incredibly powerful move from May to July, and that can give us a little bit of guidance on how to handle SanDisk and when the move might be over. So we'll talk about this more at the focus list video for members on Sunday. Okay, let's turn to the semiconductors. They're leading the market. This week, we had NVIDIA get through the 5 trillion level, which I've marked with this green line. It's come back, but it seems to be holding right around that line, which is a good sign. And the relative strength line is very strong. The next one is Broadcom. Broadcom actually has formed a little cup with handle, a little base here. If you wanted to look at it, the structure this way, it could be considered a flat base. And it broke out, and now it's pulling back. I think the only thing I would note on Broadcom is the relative strength line is lagging just a little bit. You can see here, we'd like to see the relative strength. This peak we'd like to see up here, a little higher than that peak, just to confirm this little breakout. Hasn't happened yet, but we'll keep an eye on it. And Advanced Micro had the big news catalyst of their deal with OpenAI. Earnings are coming up on November 4th. But the stock has been following through. As you can see here, earnings are coming up, but the relative strength line is showing, though, that it's still a leading stock. All right, let's turn to the Mag 7. Big week for the Mag 7 this week. Google, big earnings gap up, blowout quarter. Search results were very positive, and it's sporting a superior RS line here, where the relative strength line was at new highs even before price. So very strong. Amazon today, they reported last night, re-accelerating growth and had a gap up today. So a big gap up, and it's coming out of a consolidation. So that's a really interesting situation. This one has probably been the laggard in the Mag 7. So maybe this earnings report is a new catalyst to get a trend going in Amazon. And Tesla is consolidating the last month here. I will say we're getting very close to the old highs. The old highs from 2021 are 488.54. And this looks like it's consolidating, getting ready to break out to make a run at those new highs. So we'll keep our eye on Tesla. The relative strength line has pretty much been going flat. So if this breaks out, look for the relative strength line to turn up. Okay, let's put all the pieces together. So where are we? Right now, the markets, we're at new highs in the markets, but I will say, I've got this in red, breadth divergences continue on the S&P and NASDAQ. So I'm cautious here about putting any new money to work, fresh money right here. The power trend, the IBD power trend is still in place. That's a positive. We're above the 20-day exponential. New highs, new lows. This is a little bit concerning. We've got new lows that are actually expanding. The bloodbath indicator has turned on and fired 2 days in a row. That's a caution sign that we don't want to be too aggressive with new buys. The leading stocks, it's been very narrow this week. The Mag 7 and the QQQs, and actually if you line them up, the Mag 7 is even outperforming the Q. So it's very narrow. There are select stocks that are working, and I just had that list. We looked at the leaders. There's a good 10, 20, 25 stocks that are really working well, but stock selection is so important in controlling your risk. Don't get carried away with FOMO. There'll be plenty of time to find good entries. Exposure levels, last week we were at 65 to 70%. I am keeping that exactly the same right now because I have some caution signs in the general market. We want to try and stay with the trend. The trend is up, but it's important to have a defensive plan. Really look at your stocks closely this week, because if the market does roll over or get into trouble on a pullback, we want to know what we're going to do with each stock in our portfolio. We're trying to hold our best stocks. We're trying to hold them if we have good cushion. And I consider good cushion, profit cushion of at least 30, 40, 50%. We're trying to hold those stocks for a really big move that might be 100%. If you panic and you sell everything, it's going to be very difficult to get back in position well in the market if you sell all your stocks. So try to have a plan of how you're going to handle each stock individually. I don't think it's a time to be really aggressive here. I think caution signs are flashing. This might pass. These indicators might smooth out and we continue to move higher. But at the moment, I take them very seriously because they don't flash often. The focus right now, to me, is really on quality stocks. I would kind of avoid the speculative names right now. As I mentioned, the IPO index and some other speculative sectors, whether it be quantum or nuclear, I don't think that's the place we want to be right now. I think we want to be on some of the more quality stocks in the market, the larger cap stocks. But that's just how I'm approaching it myself. Okay, the quote of the week is from Bernard Baruch, the market financier and operator. He says, exit is the most important aspect of trading, and few people study it. This is so, so true. Most traders, particularly early in your career, only want to talk about entries, 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 buy points, buy points, buy points. Exit, selling stocks, is much more difficult, and you'll only get good at selling if you really study exits. All right, last couple of promos. For those of you that have taken our earnings reaction gap course, which is a 17-hour course, we're having our next quarterly earnings prep call this Sunday at 2 o'clock at noon. Just we're JT and myself. These are some of the names that we're going to be breaking down to get you prepared for potentially earnings gaps next week and how we would buy those stocks. So this is a paid course, and this is a paid earnings call program. If you're interested in either one, I'll put in the link below a link to this on my website so you can see what the course is all about, and you can contact me if you're interested in possibly buying the course. And as I mentioned before, exits are important. That's why we put together the Mastering Exit series. This is about 4 hours of videos that I've prepared. And those of you, again, if you want to get a basic membership, tremendous amount of educational material will help you really sharpen your learning curve. And those of you that want trade ideas in terms of buy points and names and targets, that can help you there with our weekly videos at the premium Cloudburst level and all of the advanced material. All right, that's a lot of material. Thanks for hanging with me. It is October 31st, 2025, Halloween. So have a great night if your children are going trick-or-treating, or if you have grandchildren that may also be trick-or-treating. We'll see you all on the Sunday video, and I'll see some of you on Sunday for the earnings call.